Hi, this is Mike Andrade for BreakingCall.com. This is being recorded after hours on Tuesday, January 28, or exactly 14 days from our last look at the major index technicals. With some recent downside volatility and a lot of speculation about whether some serious downside may be starting, I think it's a good time to revisit the S&P 500 and NASDAQ 100 linked ETFs. So we'll be looking at long-term charts, weekly and monthly, of the SPY and the QQQ. We did have somewhat of a relief rally today and some after hours upside in futures, apparently based on central bank action in Turkey, so we'll see if that can carry through to a little bit more sustained relief rally. Although the long-term trend remains up, there has been no major technical damage. We have had downside volatility and some divergences showing up. There are some very interesting number patterns showing up, as we will see in the charts, and we still view this as a risky environment for longs. Our time cycle forecast for 2014, published ahead beginning of the year, shows an up bias with possible topping in the January 23 to 27 timeframe, and so far the high was put in on the 21st. Our model suggests downward pressure to about the February 26th area, give or take a couple of days. If we look at the S&P 500 weekly bullish percent index, that has declined from 81% on our last comment of stocks bullish to a current reading of about 72%, which increases the chance of a short-term bounce, but is still far from oversold on a longer-term basis. The number of negative money flow divergences in individual stocks has risen fairly dramatically and increased in proportion to the number of positive divergence over the last couple of weeks. So this suggests that we still have long-term downside exposure in play. Looking first at the monthly SPY, we see the extended rally hitting potentially numerically related resistance up in the 185 area. This matches the overshoot percentage at the correction bottom and is an area with multiple resistance features. In our view, the SPY will need to make new highs before violating support at about 157 to keep the long-term uptrend in force. Switching to the weekly SPY, using similar methodology, we have important resistance in the 185 to 190 area, and important support is the recent pullback low just above 177, and there is currently a test of that level has been underway. A normal short-term pullback of 61.8% here, however, measured from only the October 2013 low, would retest about 172. We actually think that this could easily come back to 172, the SPY, and that actually we wouldn't be surprised to see 155 to 160 before this whole thing is over. Moving to the monthly Q, we see the extended rally nearing multiple resistance confluences in the area between $87 and $93. This resistance is also numerically related to prior downside moves and could be a formidable barrier after this long uninterrupted rally. In our view, the Q will also need to make new highs before violating about $70 to keep the long-term uptrend in force. Quickly looking at the Q weekly shows us a similar picture with important resistance in the 88 to 90 range. Having at least temporarily halted the advance at that level, we put weekly trend support at about 79, and then the key $70 area that approximates the bottom of the trend channel. We would reiterate caution on the long side near term with an eye toward the end of February for a better entry period. Thanks for watching, and visit us often at BreakingCall.com.